bunch of things to uncover today. We got a few things to unpack. Definitely, definitely been a lot of news in the market. Definitely been a lot of movement in the market. And it's only right that I unpack or what I'm saying, break down what has been causing the movement, where the movement will take you, how you want to position in light and in regards to the movement, and we're gonna build, man. We're gonna build a full understanding. We're gonna get a full perspective of it, and we're gonna, essentially unpack what's happening and how to maneuver through what's happening in the market. Because as you know, the markets move every day, right? Markets are gonna move every day. News is gonna be what's moving the markets, right? It can be a driving factor of how market stock prices, how stock price movement is gonna fluctuate up and down, right? So to understand what is happening in the markets, to understand what news is moving in the markets, to understand how you need to position yourself, how you need to attack, right, the mind frame in which you want to attack the markets, the strategy you might want to implement, right, because it's going to require some adjusting, it's going to require some patience, it's going to require some emotional intelligence, and it's also probably going to require some, rethinking and rebalancing of the portfolio, right, because you have to know why things are moving in the direction that they're moving in. And if you don't know why, then guess what you can't do? You can't capitalize on that movement, right? If you don't know why, you can't capitalize on the movement. And that's what we're here to do. We're here to unpack the why so we can capitalize. And that's what it's all about. So right now, CPI data is suggesting that inflation is cooling, right? So now markets are preparing for cooler inflation, right? They're preparing for lower prices, right? They're preparing for producers to be, for producers to pay to charge less for the goods that they're producing because they're getting it for from the beginning of the supply chain it's starting to cost less, and then of course now it's not taking as much of it's not taking so much for them to produce the items, the goods, and the services, right? So now they're able to charge a lot less. That's why you might see some groceries coming down. You might see some gas fluctuating up and down, things like that. This is because by the data, right? It's actually showing that you're going to be getting it's a little easier to be a consumer these days, right? And so this starts from the top. It starts from the top of the supply chain. It starts at the beginning of the supply chain, and then of course it trickles down, right? So this is a telltale sign that you're gonna be having some rate cuts are gonna be taking place, right? Inflation has gone down to the target that the Fed is looking for it to go down to, and then of course as a result of that, what's going to happen now is now the markets are going to start pricing in, because markets are forward thinking. They're going to start pricing in some of that movement, right? And it's going to reflect in the price. And just so I can go ahead and double back to what you said about the AI companies, it's always a great time to be investing in AI. It's never a bad time to have a position in AI in your portfolio, simply due to the fact that that is the future, right? That is innovation, that is disruption, that is the builders of the new world, right? And then you want to be early, right? So like investing in something like NVIDIA, it's some opportunities to be made there. But here's the thing, it's not as many opportunities investing in NVIDIA as it would be investing in one of those new players or one of those unsung heroes, one of those darlings that the market hasn't called hold to, right? This is just putting yourself in a position for the most increase, making sure that you can 10x, 20x, double, you know what I'm saying, your money and stuff like that. But it's always, man, you always should have at least, I'm gonna say at least one index, 1 to 2 tech players, and then of course, a couple of blue chips, a couple of sustainable investment businesses, right? Some consumer staples, some consumer healthcare, something that is sustainable, bigger, larger company, bigger name, but you definitely want to make sure that you keep some some tech in your portfolio. And in tech, man, it's crazy because it's not even tech can have some risk to it, bro. That's only because it's like it's relatively innovative and it's relatively disruptive, and a lot of people don't understand or they don't know what direction it's gonna go in, right? So just for example, um, Amazon was always an amazing business, right? They were an amazing business in the 70s and the 80s and stuff like that, right? But the thing is, no one knew who they were gonna be because they weren't familiar with the internet. Everything you got to think about the .com bubble and everything like that in the 2000s. People were becoming millionaires overnight from the tech bubble. People were becoming millionaires overnight from speculation, from the idea that the internet is going to be this new widely used thing that's going to change everyone's lives, right? And the thing about it is, no one knew. It was a lot of uncertainty around it. No one knew how disruptive it could be. No one knew how beneficial or helpful it could be. No one knew how it could be used to scale businesses and things like that, or the leverage it to give you, the connectability to give you. But they knew it was the future, but they didn't know how much of the future it was going to be. Like it was a lot of uncertainty around it, and that's why people end up shying away from it because they don't understand the risk. It's risk because you don't understand what it is you're investing in. But you got to think about it. It's a way that you can take the risk out of it. If you're investing in a business that is growing fundamentally, right? They've been increasing earnings quarter over quarter for 8 to 10 years. They've been growing their revenue. They've been growing their free cash flow, their operating cash, EBITDA, margin, and things like that for a long period of time, consistently throughout their history. Then for a fact this is a growing business. Right now, all you have to do now is just understand the inner workings of their business, right? And you shouldn't invest in any business that you don't know about, that you aren't competent in what they're doing. If it's not in your realm of competency, you shouldn't be investing in that business. If you can't explain what that company is doing to a 12-year-old, it's no reason why you should be owning that business. Just because it's out of your realm of understanding, right? And now you're unable to build a proper story around why you should invest in it, as well as whenever something is when it's going up and down, it's a good chance you won't know what's happening, the climate of the industry that they're in, and things like that. Peace, JoJo. Yeah, nah, for sure. Just roll back to America stuff. Yeah, for sure. That sounds like something cool. You gotta break that down to me. But yeah, nah, everyone should have a little bit of tech in their portfolio, only because it's the future. Like simply, like so, areas of interest for me, and it's been like this way for quite some time. Any company that's subscription based, any company with a subscription based model, education platforms or platforms where it allows freelancers to come utilize and leverage that platform and make some money from it. So all platforms where you got users that create the community, and people come based to leverage their expertise, like Udemy or Fiverr or something like that, right? Those company models are good. The world is more digital now, so anything cybersecurity based is going to be a great area to have in your portfolio. Just position yourself for the future. As the world becomes more digital, guess what? You need to have that digital, whether it's a currency, whether it's an ecosystem, or whatever, has to be protected, because there have always been scammers. There have always been people that are looking to take from you. So cybersecurity is going to be big in that. A lot of those models where it's like rent models, or like Turo or Airbnb, or like things like that, where you're able to leverage your liabilities, or you're able to leverage the things that you have, and then you can use that as it's just a platform, and then you got users, and it's transactions taking place there. It's a marketplace, right? So this is like the way that the world is moving towards, things like that. It's a few different areas that you want. Anything in the electric vehicle space, of course, because 2030, all vehicles will either have to be hybrid or electric, full on, right? So that's where the world is transitioning towards. Of course, the commodities that take to build these different ecosystems, from anything technology based to even just the copper or lithium that go into these electric vehicles and things like that. Like, you want to know where the world is headed. That way you can get ahead of the curve, and then you can position yourself, right? You can find the wonderful companies that are building the future, that are solving the problems of the world. And now this is how you get to where you find companies that are going to 10x, right? You find companies that are going to triple in size, and when you find companies that are going to, that are going to take your investment dollar through the roof, right? This is how you play the game. And it's just from getting ahead of the curve. You got to be early, right? You got to think about it. All the people that were, Bitcoin is almost $60,000. All the people that were investing in Bitcoin when it was what, $800, $2,000, things like that, when people were saying it was a scam and everything like that. I'm not here to argue whether it's a scam or not. I honestly don't care. But the point of the matter is, the people that were early, I promise you, they're millionaires over and over again. Now, and then you got people that are just now jumping in the game, trying to get a piece of the action. I'm not saying that you should go invest in the things that people will say, hey, it's next, hey, it's on deck, hey, it's the thing, it's the future, right? I'm not saying you go and put your dollars towards that, but what I am saying is, these are areas that you should be knowing to look in. You should be expanding yourself in order to understand that, hey, this is where the world is going, and it doesn't have to be a specific commodity. It doesn't have to be a specific asset class. It can be whatever it is, because guess what? Even in the stock market, there's always a new company that's coming to look to disrupt the industry of whatever it is, the niche that they're in, right? It's always been like that. You got to think about it. Before it was Netflix, we had Blockbusters. You can go to Blockbusters. You can go, what I'm saying, go get you some movies, rent you some movies, bring them back, right? And then guess what happened? Now the internet, now everything became more digital. Now with applications, you can download an app on your phone and you can watch this, right? And if you was investing in Netflix early, guess what you win? Taxis were a thing before like Lyft and Uber and things like that. But then guess what? You got someone who comes with a disruptive model, who has an innovative idea, and they come and they change the landscape of a particular industry or sector. And guess what? Now you have companies that specifically have, they got the Airbnb, they got the, they got the Turo, they got the, Uber and Lyft and things like that. Which is taking the need away from a lot of different things. So you gotta know where to look. You know what I'm saying? You gotta know where to look. When you know where to look, now you have the ability to find those gems and find those little nuggets of businesses that are they're golden little nuggets too, and they're gonna do some amazing things. You know what I'm saying? Well, that's the next phase is fully autonomous automobiles, right? Tesla has been pushing that narrative for quite some time now. And of course, the goal is for other companies. So when it comes down to this, now other companies are like saying, hey, how can I be first to invest in, to build in that model, right? How can I be first into self-driving, to fully autonomous motor vehicle? How can I be first in this space? That's what everyone's trying to get to now, right? So it was just the fact of the matter is, okay, everything needs to be electrical. Now it's, okay, how can we make it self-driving? And it takes technology, it takes a team, and it takes, a great vision from a great management team to put everything where it needs to be and put all the proper tools in place. So just a little, like I said, so right now it's about understanding where the money's moving to, right? Where is the money moving to? Because right now, like I said, moving the markets, but you have to understand the economy is still strong and spending is still up year over year. Credit card spending is still up. Debit card spending is still up. So you would think that in a contracting economy, because right, the purpose of having higher interest rates right now is for the economy to be to pump the brakes on the economy, to slow it down, to pull the liquidity out of it, right? But you still have a highly functionable economy right now, right? You still have a peach chocolate, sister chocolate. You still have a highly functioning economy right now. Y'all share this video too. If somebody needs to, catch a vibe and tune in and tap in and understand how to play this game, share this video. But you still need, so the economy is still growing, right? This is a good thing, but it's also what's causing one of the factors in which interest rates haven't been cut yet, right? So now, because you don't want, it's a tightrope, it's a balancing act that you got to do, that the Federal Reserve has to do between keeping interest rates higher for longer and prematurely cutting interest rates and pivoting, right? They don't want to pivot too prematurely, because now it can be a snowball effect of, inflation can pick up and go rampant again. But you don't want to keep interest rates higher for too long, because now it's something called a hard and soft landing, essentially, which is going to be reducing interest rates back down, right, to where they're supposed to be at. And of course, when you come down, you don't want it to be a hard landing, right? Hard landings produce, they produce not depressions, but they produce, downturns, and everyone has been screaming they want the economy to go into depression, or they want the economy is going to go into, the markets are going to crash and all this and all that. Everyone wants it to be something it's not, but if navigated properly, you can have a softened economy, and then have it transition into an expansion, because that's essentially what's happening. When they lower interest rates right now, they're going to be buying bonds, they're going to be stimulating the economy, enticing consumer spending, right? Because now debt costs less, and things of that nature. So you have to understand what's about to happen right now. So now lower interest rate environments are more favorable for stocks. If you look at it right now, the yield curve suggests, like with the bond, with bond in the bond market, the debt market, and things like that, it tells you that the money is rotating more towards, right now, at least in the short term, those debt markets, right? The bond market and things like that. Like the yield curve is still inverted to where it's like you have more money in short term, more liquid assets, right? Like money market accounts, high yield savings accounts, some like short term, like like T-notes, treasury notes, and bills and things like that, where you can make 4-week investments at a time, get 5.5%, 6% on your money, and keep it pushing, right? Keep it super liquid and things like that. The economy and the markets tell you where everything is going, right? They tell you where the money is flowing, and you got to understand where the money is flowing. You have to understand where the money is flowing in order to transition and prepare for what's to come, right? Because you got to as an investor, you got to adjust. You got to be able to maneuver with the markets, because guess what? The markets aren't. It's an entity, right? And it's an emotionally driven entity. And as the Federal Reserve raises and lowers interest rates, right, when they're essentially manipulating the economy, right? They're telling it to go into a boom. They're telling it when to go into a bust, and you got to be prepared either way, no matter what direction they tell it to go in. Right now, we're pulling liquidity out of the economy by raising interest, by having higher interest rates, right? But as a result of this, guess what's going to happen? This is going to create a retraction on the economy, right? So now you have businesses that are. Guess what happened as soon as people start raising interest rates? People start getting laid off by the tons, like by the thousands, right? You notice this happening. You started seeing it be a trickle effect. Now you have, and it's crazy because the financials benefited from it the most. That's why they were able to raise interest rates and everything like that. They benefited from this the most. You're seeing where the money is flowing right now. Companies' earnings are showing you where money is flowing. It's flowing to tech. It's flowing to financials. It's flowing to consumer staples. It's flowing to healthcare. It's flowing to utilities, right? It's flowing to commodity. Gold is pushing up an all-time high. You got to know what's happening. You know what I'm saying? You got to know exactly what's happening. Hey, appreciate everybody tuning in. Y'all share this video. You got to know what's happening. You got to know where that money is flowing. You got to know where that money is going, so you can get your money growing, right? This is how it works. This is how the process of becoming an intelligent investor works. It's more than just, this is what you buy, right? I can tell you what to buy all day. That don't mean you're going to make a penny on it, right? Or you wouldn't make as much as me because you don't know how to play the game. Because right now, it's a tide. The tide is about to be shifted when the Federal Reserve decides to lower interest rates next month in September. The tide is going to shift. We're going to go from tightening to easing, right? From pulling liquidity out to adding liquidity in, right? This is going to create more inflation. This is going to create more, and it's going to entice borrowing. It's going to entice more spending. It's going to make more liquidity, have more liquidity in the markets as a whole, which is going to push the prices of stocks up, because typically, and this is just historically speaking, stocks do better in a lower interest rate environment, right? They do better. So this is just understanding the nature of what it is you're looking to do, because how do you call yourself wanting to make some money from investing, but you're unable to capitalize on the investment opportunities? If you don't know how to play the game, if you don't know how to position yourself, if you don't know where to put your investment dollars, then guess what? You're not going to maximize your profitability. You're essentially playing the game with one hand tied behind your back. I'm not saying becoming a master economist. I'm just saying look to follow the breadcrumbs. That money leaves clues. It leaves a trail of breadcrumbs. And if you know where to look, if you can get on the path and stay on that path, then I promise you, you're going to make sustainable, profitable, practically safe investments. And that's what it's all about. Like right now, if you didn't do anything over the course of this last year and a half with higher interest rates, the least you should have done was invested into a money market account, or investing into, put your money in a high yield savings. Even if you got a CD, CDs aren't as liquid as other investments, because it's a lot. They want you to lock that money up for a set duration, and if you go to pull it out, they'll penalize you. But the debt market has been lucrative right now. So basically, what the debt market is, even if you put your money in a high yield savings, banks are just using that money right now because interest rates are super high. So they're just taking your money. It's something called fractional reserve banking. They can use your deposits and lend it out to other people for credit products, for credit cards, loans, mortgages, auto loans, whatever the case may be. They can lend that money out. So now they're making more money based on this because interest rates are higher. So now they're earning more from their investments. They're earning more from their deposits. They're earning more from the products that they're lending to people, and they're giving you, the consumer, more for letting your money sit in their account. So if you haven't done anything else over the course of this past year, right, the least you should have done was invested in some form of debt, whether it been bonds, treasury bills, whether it been treasury notes, whether it been high yield savings, whether it been, there's some million high yield savings right there, whether it would have been money markets accounts, no matter what it would have been, you should have put the least you should have done, because why? Because this money is insured, FDIC insured up to $250,000. Okay, the FDIC is a department of the federal government that protects your dollar from loss. Okay, basically what they'll do is, if a bank happens to go under, if a bank has bad money management skills, or if a bank isn't prudent in their investments and the economy gets shaky and they need to sell off assets, or if they begin to go under, or whatever the case may be, the FDIC ensures that your money is safe. It's the insurance policy that you won't lose a penny because that bank went under. Okay, that's what the FDIC does. Their whole purpose is to make sure that you don't lose a penny. So the federal government will buy banks' assets. They will buy the bank, like they will take it over. They come take over the bank and ensure that your money is safe. And of course, what they want is for other businesses to buy it from them. If need be, they will. And you don't have to worry about the federal government running out of money, because guess what? Whenever they need more money, because they have a balance sheet that they have associated with the businesses that they're able to buy, the banks they're able to buy to keep them running. But the thing is, if they need to, they can print the money in order to sustain the insurance that you have on the money that you have in these accounts. So the least you should have done as a consumer was utilize the high yields that are available to everyone right now, because this is the safest form of investment. Who doesn't want to make a 5.5%, 6% return on your money for doing absolutely nothing, right? I'm not talking about picking stocks. You have to have some form or sort of stock picking ability or investor acumen, understanding fundamental analysis or technical analysis, or mix of the two, or whatever have you, in order to be able to make a accurate investment decision, right? But when it comes to just putting your money inside of a high yield savings account, it takes no intelligence whatsoever, because guess what? You put your money into a bank anyway. The only thing about the bank that you got your money sitting in, they don't offer you any income from it. They don't give you any interest on the money that you got sitting there that they're making money from, because they're investing your dollars and they're getting a return on it, but you're not getting a return on it, right? That's the only difference. The only difference is you don't have the the awareness, right? You don't have the financial understanding to know that, hey, the very least I should just put my money in a high yield savings account and get something for it, get 5% on it instead of getting absolutely nothing, right? That's the only difference. So you need to know where the earnings are suggesting that you put your dollars at, right? So this is one way to understand where money is flowing so you can know where to put your money at, right? How are the sectors rotating? It's 11 sectors in the stock market, okay? At any given time, you'll have about half of them up in a bear market. The other half will likely be down in a bull market. I mean, be down in a bear, be down in a bear, and then up in a bull. It's typically half and half. Now it's up to you to be able to follow the clues. It's up to you to be able to say, hey, this is where the money is going, this is where the money is flowing, and everything like that, in order for you to be able to, get the most out of your investment dollars. A lot of times, right now, a lot of it, everything is so easily accessible. Everything is so, what's the word? Everything is so like at the touch of a fingertip. Everyone is so interconnected that you're looking for someone to tell you which way to go as opposed to learning how to navigate. You know what I'm saying? If you learn how to navigate the stock market, if you learn how to navigate the economy, if you learn how to navigate, proper money management and things of that nature, then you will essentially have a leg up to where, hey, now you're making money. You know what I'm saying? Now you're making money, right? So that's basically what that means. And then you got to understand that when it boils down to it, man, the markets have been extremely volatile lately. They've been extremely volatile because it's a lot going on, right? So it's a lot of news that's moving the markets right now. It's a lot of new things coming about. So you got to think about it. CPI come out, Consumer Price Index, the Producer Price Index comes out, the jobs report comes out. You got earnings that come out. There's so many different things that got the markets moving up and down. And then of course the markets are forward thinking. They start pricing in what's about to happen in the economy and how it's going to impact business, how it's going to impact stocks and things like that. You got to be prepared for a volatile market. So this means that you have to be patient, right? Because you got to think about it. Last week, well, we had one of the best weeks in the market last week, right? But it was a rebound from a well-needed correction, a well-needed pullback that we've been needing for quite some time. So this was a rebound, right? So the last week was a rebound. The market pushed up in a massive way. Why? Because investor sentiment is at a high right now, right? The VIX lets you know what direction the markets are moving in. It's a fear and greed volatility, right? It's a fear and greed index. It's an index in the market, just like the S&P 500 and NASDAQ and things like that. It tells you, are people being greedy or people being fearful? When people are being fearful, that means they're sellers. And when people are selling, that means stocks are trading at a discount. This is what you want as an investor, because you make your money when you buy, not when you sell, right? You make your money when you buy, not when you sell. Remember that. So you want to catch them at a discount. When people are being greedy, guess what's happening? They're buying up stock. They're buying up stock, and this is pushing price up. That's great. You want to catch those profits when you can, but at the same time, you got to understand that investing is a long term game, right? So if we understand it's a long term game, and I'm not looking to cash out on none of my. I'm not. You know what I'm saying? You might. Everyone has a different investing style. I'm not looking to cash out on those profits because that company is still a wonderful business. I'm not gonna go selling every time it goes up in price, right? I'm not chasing dollars. I'm chasing long term wealth. So you gotta think about it like from that standpoint. Just certain things don't make sense. And then, like I said, buying. It's all about buying low. Like the more money you'll find yourself making is going to come from the lower you get in at that investment, right? The lower the entry that you make. Entries matter when it comes to investing because you stand to make more money in compound interest. You stand to make more money in appreciation, and then of course you're buying more shares at a lower price. You know what I'm saying? Like so, that's the name of the game is to buy low and sell high. So you don't want the markets to be constantly pushing up. It might be good for like you might make you feel good that your portfolio is going up and things like that, but it's an unhealthy market because at that point, because that means that the market, like every company earnings don't reflect the growth of the market. Every company's earnings don't reflect the market appreciation as a whole, right? And what this means is the stock's price is becoming detached from that company's business fundamentals. That business fundamentals don't suggest that it should be trading at such a high valuation. This is an unhealthy market. And what happens is it creates a bubble and things get inflated, and but everything that ends up having a bubble and is inflated, guess what, it always pops and it comes back down. So either the stock's price will have to come up to where the earnings will have to come up to where the price suggests, or the price will come back down to where the earnings suggest. And this is just understanding what happens in a volatile market, so that way you can put on your intelligent investor cap, and now you can sit back and you can assess the state of the market, right? You can assess what's happening. You can assess, hey, the market is pushing up. Why is the market pushing up? Well, it's because of news. It's because of AI and tech has been booming. So now all the markets are pushing up based on that. Or, oh, why are the markets booming right now? Well, it's booming because the investors are pricing in, the markets are pricing in rate cuts, right? They're pricing in a pivot. So now people are more positive. It's a more positive sentiment towards the market. So guess what they're likely to do? Let me put some money into this stock, right? Because I feel like the markets are more safe. They're more geared towards my investment, like my investment horizon, right? And when that happens, now you have people that are, like I said, it's just money flowing. It's money flowing. So when the money starts flowing in a certain direction, it just drives the price up. And sometimes, like I said, it's okay. We invest to make money. And right, the only way we make money is when that price goes up. But here's the thing. You got to know the difference between a healthy stock market and an inflated stock market. In an inflated stock market, you stand to lose a lot more than you would think, because if you buy when the price is high because the markets are inflated, guess what? When that price is going to eventually hit a stalling point, and it's going to reverse and it's going to correct itself. And now you're left holding the bag. You know what I'm saying? You bought a $20 stock for $40 because the markets were pushing up, and then when it starts to correct and goes down to 30, now you're at a deficit. You're down 50%, and you know what I'm saying? You don't know what's going on. Well, you didn't buy a worthy investment anyway. You didn't buy an undervalued company anyway. So now you're now you're left to deal with the pains of what the stock market can do for you, because the market can be your best friend, it can be your worst enemy, all depending on yourself, right? Because if you're not playing the game the right way, if you're not playing to win, if you're gambling, if you're just looking for that next hot stock, but if you're not willing to go do the work and learn how to find the next best company, right? You're not doing the work to that suggests that you're in tune with what is moving the market. You're not in tune to where the next surge of increase will come from in the market. You're not aware of where investor dollars are going and flowing, and you haven't built the understanding of how to get the most and extract the most from the stock market. You're going to be playing a losing game. It takes emotional intelligence and it takes patience to win this game. Emotional intelligence just suggests that, hey, I'm not going to be chasing the bag. I'm not going to be chasing dollars, because you will never lose a single penny on an investment that you didn't make. You will never lose one penny from not putting money into an asset. The only time you're going to lose is if you jump in not knowing what you're doing, taking advice from someone else, or not learning how to play the game, right? Or buying at a high when you should have been patient, waiting on that price to pull back, because it always does. I don't care if it's next month, I don't care if it's next year, I don't care if it's next week, the price will come back down to where the fundamentals suggest in due time. You just got to be patient. You got to be emotionally intelligent enough to know that, hey, since price is surging, I need to definitely trust my instincts, trust my education, trust my research that suggests that I shouldn't be jumping in when price is pushing up, because I don't stand to make as much as if I don't stand to make as much as if I would have positioned myself properly in the beginning at the bottom when I should have, right? Instead of, oh, everyone's talking about it now, oh, every price is pushing up, let me jump in. That just lets me know you don't know how to play this game, because I don't mind investing in something at the bottom when price is low and it's continuing to go down until it bottoms out and hits a real bottom, then it reverses and goes back up, because it's a growing company. I understand that this business is growing fundamentally. I understand that the price oftentimes of the stock isn't a reflection of the business's fundamentals, because I know that sometimes the market does something different than what the business suggests that it should be doing. I know this, right? So now I'm able to make informed and intelligent decisions in regards to my investments. This is how you play the game. This is how you play to win. And a lot of people that you're listening to aren't telling you this. A lot of people that you're listening to, you see them post a little, oh, I just made some money doing this. Come take this. Come consume this product right here that I just came up with, so you can do exactly what I'm doing. But they're not teaching you how to fish though. It's just that emotional trigger that comes from, as humans, we see someone just made some money. Oh, I want to be able to do that. But you're not gonna learn how to play the game. So now all of a sudden you always gotta come to them to get fed plays. Oh, where can I learn? Where should I buy it? What's a good price to buy it? What's a good company to buy? Instead of it being, how can I learn what's a good company to buy? How can I learn what's a good price to buy in that? How can I learn how long to hold? Right? You gotta want to get the information that's gonna change your situation, or you're gonna continuously be one of those people that's on the outside looking in, wondering why nothing's changing for you, wondering why you're still in the same spot, wondering why your portfolio isn't growing, wondering why, man, why every time I buy a stock it goes down in price, and then by the time I look up, by the time I turn around, after I done sold at a loss, it done doubled in price from where I bought in at. You know what I'm saying? You gotta learn how to play the game, man. You gotta learn how to play the game. We gotta play to win. Like, what are you doing? What are you doing? Are you playing to win, or are you just in the way? Like, you know what I'm saying? Like, because at the end, you playing with your own money. It's your money. How you gonna jump in and start doing something you don't know really what you're doing, and you just gonna lose money? Like, if that's the case, you might as well just give it away or donate it to charity or good cause. At least something good will come out of it. If you're gonna mess over the money and fumble the bag anyway, man, just go ahead and give it to somebody that could use it. You know what I'm saying? Like, at the end of the day, you gotta get to the point where you truly learn how to play this game. And you gotta start taking your financial education more serious. If you take financial education as serious as you should, you're gonna get the result that you're looking to get. You know what I'm saying? Like, understanding that the markets will be volatile, understanding that consumer price index data just suggested that inflation is lower, so it's gonna be better for stocks relatively soon. Like, it takes a while, it's a lagging effect, but it's going to be trending in the right direction. Once they cut interest rates, trust me, it's trending in the right direction for stocks. It's trending in the right direction for a lot of things, trust me. Um, Understanding that the markets will be volatile. Markets have always been up and down. You'll never see a day in the stock market where the price of every stock is absolutely flat from start to finish, from the open to close, from that bell first rings at the beginning of the day to when the market closes. It'll never happen. Prices fluctuate every single day in the stock market. They're always up, they're always down. They'll never be flat. So if we know that the prices go up and down every single day, now it's just, okay, how do I learn where to put my money in order for it to go up more than it goes down? That's the next part to the equation. The first part is, I know stocks go up and down every day. The next part is, how do I put my money somewhere in order for it to go up more than it goes down? Because that's essentially what you're looking to do. If you don't invest, your money will lose value by way of inflation every single day. If you do invest and you don't make wise investment decisions, you'll lose money way faster that way than you do by just letting it sit. So oftentimes it's better to just do absolutely nothing, learn how to play the game, right? You don't have to pay something. You gotta pay attention. You gotta pay attention to someone who knows what they're doing. You gotta pay in time and energy that you're putting into what you're doing, right? Or you gotta pay in dollars and go pay for a book, go learn from a mentor, go join a class, join a course. You gotta do something. You gotta pay in order to get the return on. You gotta do something, or else you're just gonna be constantly over here asking people to lend you plays, or instead of you putting the work in and learning where you should be looking at. You know what I'm saying? Like, it's easy if you put a little bit of effort into it. You know what I'm saying? Like, doing the fundamental research, listening to those 10Ks, right? Those annual reports, listening to those 10Qs, those quarterly reports, reading those financial statements, those balance sheets, cash flow statements, income statements, things like that. Listen to those earnings calls. learning what a good management team looks like. You gotta understand, these are businesses. Businesses are run by people, and a properly run business is gonna continue to be a growing business. A growing business equates to a growing stock all the time, every time, and it never changes. Trust me, that's how it works. Why do you think Apple has over 1,000% return from all time, and the same for Microsoft, the same for Tesla, the same for a lot of these other giants of a company, giants of businesses, because they've been growing fundamentally over the years, Amazon included. They've been growing fundamentally over the years, and now they're at the point in which they're so large that had you would have invested when they went public, you'd have over 1,000% return on your money. But you got to be emotionally intelligent enough to ride that wave, because guess what? During a good economy, the price is gonna reflect in the stock, is gonna go up, it's gonna trend up. During a bad economy, guess what? You're gonna feel the brunt of that blow. Trust me, there's a lot of stocks that were beat up a year and a half ago. Facebook is a $500 stock right now. A year and a half ago, in the bear market in 2022, Facebook was a $99, 80 something dollar stock. It wasn't worth, the business wasn't worth it being an $89 stock, but the economy and investor sentiment led to it being an $89 stock. You see what I'm saying? Amazon was under $100. Amazon $300 stock today. Everything got knocked down in a vacuum in the bear market in 2022. Everything, man. All the best companies you can think of, Apple, Nvidia, all of these amazing companies right now that are pushing up, that are widely talked about and everything like that, their prices, I can assure you, took a 30 through 70% haircut at that time in that bear market. That's what happens in bear markets. But guess what you have to be doing? A buyer of stock. You know what I'm saying? This is called buying when being greedy when others are fearful. When people are fearful, they're selling stocks, and selling drives pricing down. Right? When that happens, guess what you should be doing as a prudent investor, as an intelligent investor? You know for a fact this is a wonderful company. They've been growing their company fundamentally for the last 15 years. And here's the thing, even though the economy is slowing down, even though the economy isn't favorable for this industry, the industry that they're in, or this particular market, that business is still growing and improving fundamentally every quarter of every year, even in a down year. This is how you understand. This is how you pick winning stocks. This is how you pick winning. You know what I'm saying? This is how you pick winning stocks, by by buying amazing businesses at an undervalued price. That's how you win the game. That's how you win the game. Anyone that's watching this video, I encourage you to share with somebody. Share it on your page. Please share it, because someone needs to hear this. Someone needs to find out how to play the game. If you know someone who's looking to learn how to play, join Stock Market Education Center. I'm building a community where I want people to come learn together, earn together, and get some financial education that's